The growth of private equity has been one of the biggest developments in the financial sector in recent years. Private equity involves investing in private companies or taking public companies private with the goal of increasing their value over time and eventually selling them for a profit. It's become especially popular with institutional investors, including public pension plans. But a new policy brief for the Reason Foundation urges fund trustees to exercise caution when considering increasing their exposure to private equity. It warns of a lack of transparency over the fees involved and the returns investors can expect. Here's an interview with the report's author, Larry Pollack. In it, we discuss some of the key questions trustees need to address. This video is brought to you by IFA Institutional, which provides evidence-based investment solutions for institutional investors. Here are a few things you're going to learn. First, private equity has not outperformed publicly owned stocks since the global financial crisis.
Investors probably could have gotten the same types of market exposures in the public markets that they got in private equity for much lower cost and likely outperformed private equity. One big reason being the cost.
Just because you can't see the price every day, that doesn't mean private equity isn't volatile.
Cliff Asness, who's he's the founder of the hedge fund company AQR, he coined a term for it that has been pretty widely adopted. He's been promoting a bit, which he calls it volatility laundering, to describe the understatement of risk.
Private equity funds that will outperform in the future are almost impossible to identify in advance.
The difference between the top and the bottom is huge, but it's virtually impossible to know in advance who's going to be or what fund is going to be a top quartile performer.
And pension funds and other institutional investors are likely to be better off with index funds.
If you're a public pension fund, are you sure you're going to outperform Nevada, which has like a 3-person investment staff and invests, almost exclusively in index funds, and has outperformed almost every other public pension plan in the country?
Here then is my conversation with Larry Pollack. So Larry, thank you very much for joining me.
Oh, my pleasure.
So briefly summarize, Larry, your own professional background and expertise and explain what the Reason Foundation actually is.
I worked as a pension actuary for about 25 years. So I was kind of a regular pension actuary. I pivoted to the asset management industry in 2011. I was working for a boutique pension consultant. That consultant was acquired by Goldman Sachs Asset Management in 2015, and I stayed there until 2020. So all of my kind of corporate work experience, if you will, has been with regard to corporate pension plans. Since then, I've been sort of semi-retired, doing a little independent consulting, research, and writing on topics that I find interesting. One of which is public pension plans. I'm a co-author on a paper about that, including especially proper liability measurement, being an actuary, as well as kind of investment strategies and just public pension finance in general. The Reason Foundation is a think tank, and they have something called the Pension Integrity Project, what they call. And by pensions, they're talking about state and local government pensions. So the decision to explore private equity was kind of a joint one with them. I had written a piece with them earlier on reaffirming kind of fiduciary principles. So I had written that earlier paper, and then after that one was complete and released, they thought private equity was a good topic to explore because there's so much investment in U.S. This is U.S. public pension plan. So there's just a ton of investment from U.S. public pension plans into private equity. So, that was, and they felt that there wasn't a very good understanding of it, which is perfectly natural considering how opaque the world is. So they thought it would be good to write a primer for public officials and plan officers and people on the plan, the pension boards, to help them kind of get a high level understanding of private equity.
Perhaps you could just explain it in pretty simple terms what private equity actually is, and how investors, both institutional investors and indeed ordinary retail investors like you and me, can invest in it if we want to.
Sure. So, equity is just another word for stock or, shares on, which represent fractional ownership in a company. Shares traded on a public exchange like the New York Stock Exchange or the London Stock Exchange, are described as publicly traded or public. Now, private equity is just equity. It's shares that aren't traded publicly. Any incorporated business not publicly traded is essentially a private equity company, but for purposes of our discussion and for the investments that are made by investors, the companies have to be a certain size. So, for example, they probably have to be at least as big as companies that are, smallish to mid-sized companies that are publicly traded. So they have to be, of a minimum size to make this whole thing worthwhile. The way that most institutional investors invest in it is through something called a limited partnership. The limited partnership has a general partner, which is usually a private equity firm, and some of the bigger ones, more famous ones, are like Carlyle, Blackstone, Powell. That firm is called the general partner. An institutional investor, like a pension plan or a sovereign wealth fund or something like that, would be a limited partner in one of these funds. So the general partner is, basically running the fund. They're getting all the legal ducks in a row and lining up investors and lining up the investments for this fund, which is it's a closed fund, basically. Meaning the closed fund means, for one thing, that it's supposed to expire in 10 years or so, at which point all the investments are going to be liquidated and the fund is closed. Some institutional investors get to invest in private companies directly, either by what's called direct investing, so some arrangement between the investor and the company itself, or being a so-called co-investor alongside a general partner. So, the general partner allows them to kind of invest next to them. The general partner holds some of the stock in their fund, but it's possible for an investor to invest alongside that as a co-investment. One of the advantages of that is that there are lower fees for the investor. And to the general partner, one of the advantages is they can then hold more stocks in a particular fund. So that's the institutional side. For retail investors, in the U.S. at least, and I think it's probably like this elsewhere too, and maybe you can tell me, but most retail investors can't buy into private equity. Someone has to be there's a term, accredited investor, which means someone who has at least an income of a certain amount or wealth of a certain amount. Otherwise, ordinary investors like you and me aren't really allowed to invest in it.
So give us an idea, Larry, as to how allocations to private equity among public pensions has grown.
Yeah, the total assets under management, has grown from about $2 trillion in 2012 to about $8 trillion today. So it's, quadrupled. It's, if you look at the graph, it, looks like an exponentially growing thing, although it's flattened out in the last couple of years. As for the reasons, there are a lot of claims that private equity has made and a lot of beliefs around it. In particular, one of the beliefs is that private equity will have higher expected returns because the general partner is so skilled in picking the companies and maybe improving their management, that despite the fees associated with that there will be, much higher returns. Part of the theoretical basis for that belief is what's called, an illiquidity premium. The money's kind of tied up for 10 years in this partnership, and that means the market should pay a return for that. So, that's probably the main reason for the interest. And, there is some historical basis for that, but there are a lot of people who are very skeptical, including myself, how that's going to look going forward.
Okay, well, we'll look into that a little bit more later in the interview. For now, though, you explain in your paper that private equity portfolios are, by definition, actively managed. There's no private equity equivalent of an index fund. And this inevitably means they're less diversified. Typically, how heavily concentrated, how specialist are they? And how few companies might a typical private equity fund hold?
Yeah, I mean, a typical fund is probably 10 to 15 companies. And the companies don't all have to be in the same industry, but if a fund sponsor, if a general partner has some kind of particular expertise, then a fund might be concentrated in a particular industry. With 10 companies or 15 companies, the ability to diversify is obviously somewhat limited. And that, one of the things that you see in private equity is that there's a big dispersion of returns between the top performing funds and the, say the top quartile and the lower quartile. And, I think it's reasonable to think that maybe part of that, the reason for that dispersion is the fact that these funds are not diversified. It's a much wider dispersion than you see it, among even active public equity funds.
Investing in private equity is more expensive than investing in public equities. What sort of cost difference are we talking about? And how do private equity structures typically work?
So the prototypical fee structure for private equity is the same as you see like in hedge funds and maybe some other alternatives, which is called 2 and 20. And what that means is that they charge an annual 2% of committed assets, an annual fee of 2% of assets. So, and then the 20 means that they take 20% of the profits. So recent competition maybe is putting pressure on that downward. So maybe instead of 2 and 20, it's 1.5 and 15. But the fees are quite sizable nonetheless. In contrast, for institutions who invest passively in large cap equities, fees can be, very low, like a couple hundredths of a percentage point of assets, in contrast to the 2% of the 2 and 20. And they can be like even just a few tenths of a percentage point for a typical active investment in public equity. So, the private equity fees are certainly much larger.
Staying on the subject of cost, a point you rightly make in your paper is that private equity entails a number of additional expenses, over and above the fund management charge. One study found that PE firms spend typically 4.7% of a fund's total commitments on legal costs, for example. That's an extraordinary figure. And yet there can be other costs too, can't there?
Yes, I mean, it's a very costly endeavor, and if you think about it, it's fairly clear why, right? You're starting with nothing, a gleam in a private equity manager's eye, and they're starting this thing from scratch. They go out, they get commitments from investors, then they have to, and a lot of this is legal, but they have to get commitments from investors. There's a lot of marketing costs associated with that. They have to find companies to put in the fund. One aspect of these funds is that a lot of times investors commit funds before they even know what the companies are in the fund. So you're starting this thing from scratch. You have to find companies. You have to find investors. You have to find 10 to 15 companies to buy. You have to negotiate sale prices. You have to audit the financials. You have to analyze the markets they're in. You have to negotiate, as I said, you have to negotiate the purchase price when it's time to sell it. You have to negotiate the sale price. if you end up taking some of these companies public onto an exchange, you have to prepare an offering. Maybe you'll have investment banking fees, government filings, roadshows, whatever is associated with a public equity offering. You also have to negotiate what are called side letters, because some investors, some of these limited partners, negotiate special terms with the general partner in what are called side letters. So, you have those investments, you have those documents to draw up and sign. And then during the time that a fund owns a company, the fund sponsor, the general partner, may be actively involved in managing that company, maybe tweaking the business, tweaking the management. They may charge portfolio companies fees for some of this, the portfolio companies themselves, but obviously, it's ultimately the investors who are paying for those fees as well.
Another challenge investors in private equity face is finding out how well or badly their investments are performing. As we discussed earlier, private equity investments, unlike public equities, are illiquid. We can't just check the latest prices. How big a problem is this?
Yeah, I personally think it's a big problem. If you look at a lot of securities regulation, like, the Securities and Exchange Commission in the U.S., a lot of the regulation, a lot of the laws around publicly traded securities are around disclosures and protecting investors. Now, the theory with private equity is that the investors are sophisticated and can take care of themselves. So there isn't a lot of regulation around it. The SEC has tried to move into that area in the U.S. With limited success. They actually lost a lawsuit recently. But, if you're talking about a public pension plan board in the U.S. that might have, retired teachers and police officers, they're probably not all that sophisticated. So, this lack of transparency and the inability to kind of monitor, I think is a big problem. You're committing capital for 10 years. You won't really know how it performed until the fund is finally liquidated, until the investments are liquidated and you get money back. And that can last 10 years, sometimes longer. Some of these general partners have a clause that may allow them to extend the fund term. So you could be even looking at longer than 10 years. And then along the way, you are getting some values reported to you if you're the investor. But those are basically appraised, right? You can't see how they're traded. Like, as you point out, you can't just, open your computer and look up what the price is. Those prices that you're getting are appraised, basically. They're basically appraisals. They're estimates that the general partner is in charge of. They may hire somebody to do it to add a veneer of impartiality. But they're just best guesses, essentially, at the end of the day. They're usually reported with a 3-month lag. And the appraisers, however independent they may seem, have some significant incentives to nudge the appraisals to the high side. As these investments have come under pressure in recent years, and you see some creative ways that the general partners have been trying to exit funds and return funds to investors, what you're seeing a lot of is that on these exit transactions, the amount realized is much lower than what the most recently appraised value is. You can see these kind of haircuts, if you will, of 15 to 25% or something like that. So they're significant. So there's significant reason to doubt the reliability of those appraisals, or at least their usefulness.
Your paper suggests there might be reasons why now may be a particularly bad time, if you like, to be investing in private equity. To quote from your paper, you say private equity is facing significant market headwinds from higher interest rates and other economic development. So why, Larry, are higher rates problematical as far as private equity investments are concerned, and what other economic developments are you referring to there?
higher interest rates make it more likely that a portfolio company won't be able to service its debt. And the portfolio companies tend to have a lot of debt. I mean, part of the playbook is to is to load these companies up with a fair amount of debt, much more so than you would see in like publicly traded companies. I mean, publicly traded companies have debt as well, but you're going to see a lot more of it in these types of companies. So with higher interest rates, that means they have to pay more interest. That makes it more difficult for them to service the debt and puts them more at risk of bankruptcy in the end. In a really high stress situation, or maybe not even that high stress on it. Depends, I guess. Another thing with interest rate, there are different levels of debt too. So sometimes the portfolio companies have debt, and then sometimes the fund itself, general partners will take on debt for the fund itself. So the fund itself actually is taking on the debt, and the collateral for that debt is all the portfolio companies, not even a particular. So there are these multiple levels of debt. I mean, another way that high interest rates affect valuation is, if you think of the value of a company as the discounted value of its future profits, higher interest rates mean that the discounted present value of those future profits is lower. So the profits may be lower because of the high debt servicing, and the present value of the profits that you have long term may be lower. So higher interest rates, will have a tendency to push down, and interest rates obviously have come up a lot from their lows from a couple of years ago, all over the place. As for other economic developments, any economic slowdown has the potential to affect private equity portfolio company as much as any other company. But if you imagine a heavily indebted company whose business comes under stress because of economic difficulties, that makes it even more harder to service the debt. And again, these companies have so much debt that it puts them, they're more sensitive probably to an economic slowdown than a typical publicly traded company might be. So, in terms of the public equity industry itself has some specific headwinds. One of which is that, as we were just talking about, the reported values are likely higher than the values that a lot of these companies will ultimately get cashed out at. So, that will come through to an investor as a negative return. And related to that, one of the reasons for that is that these, exit opportunities have been drying up. So, the way that these companies typically exit a private equity fund is they might get sold to what's called a strategic buyer, or basically a company in the same industry that wants to, bolt on some scale, or maybe a supplier or something. Or the companies go public, and there hasn't been much activity along either of those lines in recent years. And finally, this isn't really necessarily strictly economic, but at least in the U.S., there is a lot of regulatory scrutiny of private equity companies, both in terms of how they treat investors, how they can become monopolists in different industries. There's a lot of concern about that. Like if you buy up all a certain type of medical practice in an area and then jack up the prices, nursing homes. So there's that kind of concern. There's a lot of antitrust concern along those lines that the regulators are looking closely at, as well as the disclosures to investors as the regulators come to realize that the investors maybe aren't as sophisticated as they thought they were.
You called your paper, "Is Private Equity a Public Investment Hazard?" And in it you describe an almost symbiotic relationship between public pensions on the one hand and private equity funds on the other. So how reliant on each other have public pensions and the private equity sector become?
There's a big database that's maintained by the Center for Retirement Research, at Boston College. And according to their database, and their database is kind of the go-to place for statistics for public pension plans. According to their database, these days, about 14% of U.S. public pension assets are in private equity, and that's up from like less than 4% in 2001. So it's going up despite all the headwinds that are fairly well publicized. A lot of large public pension plans are announcing plans to increase that further. Now, going in the other direction, the paper cites one source saying that public pension plans comprise 35% of private equity capital. There's another source that says 67%. Obviously those are two very different numbers, and I've tried to reconcile them. I've had some difficulty. I suspect the differences, maybe the way variances in how things are reported, U.S. versus global, the various details around the reporting. I don't know. Another indication of significance of U.S. public pension plans for the private equity industry is that if you look at investor commitments to private equity in 2023, 17 of the top 20 in terms of dollars were from public pension plans. So the public pension plans are shoveling a lot of money. I mean, the biggest was actually the Abu Dhabi Investment Authority, but 17 of the 20 biggest were U.S. public pension plans. So clearly, the public, the private equity industry is reliant on them, and vice versa. So however you look at it, each is very significant for the other.
The overriding message of your paper then is that private equity investors should be much more cautious than they are about some of the claims made by private equity funds. I'd like to look at three of those claims in particular in turn. And first, is it true that private equity has outperformed public equity historically?
I mean, probably not on an apples to apples basis. One issue is what do you use as the performance of public equity? Most investors use the S&P 500. Now there's a paper, a 2020 paper in the Journal of Alternative Investments, which found that compared to the S&P 500, if you look at the roughly 30 years between like 1986 and 2017, private equity looks to have performed better than the S&P 500. But one thing that this paper did was they said, well, what if we compare it to a market basket of publicly traded small value stocks, which is something, that is probably a more appropriate benchmark here. It more closely resembles the companies that are in a private equity fund. So when they did it on that basis, private equity actually underperformed over that 30-year period. Because people think of the S&P 500 as standing for public equity, if you compare the returns for public equity, especially if you go back to the 1980s forward, because those, the early years were, the market has changed a lot since those early years. Nowadays, there's a lot more private equity companies chasing these investments, a lot more money pouring in. So that makes it more difficult to get outperformance now than it was back in 1986. So things start to look different when you look over, say, the last 15 years or so. So these same researchers found that after 2006, returns were about on par with the S&P 500, but below the return of a more appropriate public market index. So in other words, investors probably could have gotten the same types of market exposures in the public markets that they got in private equity for much lower cost, and likely outperformed private equity. One big reason being the cost. I was going to say, as I said before too, there's just such a wide dispersion of returns too. So when you start looking at averages and comparing averages of private equity versus public equity, there's much less dispersion in public equity and a much wider dispersion in private equity. So there's a much greater chance in private equity that you're going to underperform, even if maybe some average tells you otherwise.
A second claim that PE funds often make is that private assets are less volatile than public securities. Is that correct?
I think a no is in order for that one. There is, the apparent lower volatility and what gets reported as lower volatility is almost certainly an artifact of the fact that these appraisals of these portfolios are very infrequent. So that the fact that you can't see these things move around in real time makes them appear to be less volatile. If those are the volatility measures that you put into your models, the reality has to be that a company that's private, there's no reason to think that the value is less volatile than an identical company that happens to be public, right? I mean, there's no reason. So that it's just an probably it has to be an artifact. In fact, Cliff Asness, who's he's the founder of the hedge fund company AQR, he coined a term for it that has been pretty widely adopted. And he's been promoting a bit, which he calls it volatility laundering, to describe the understatement of risk.
A third claim made by the industry is that private equity provides investors with diversification. Is that true?
I find that hard to believe. To the extent that private equity is a portfolio of small to mid-sized companies with leverage, there's no reason why it should provide any more diversification than similar publicly traded companies. There are companies that go back and forth between private and public. So why would one expect that something kind of magic happens when a company makes that transition? In one case, it's not diversifying. In the other case, it is. And to the extent that such a claim is based on some quantitative analysis of observed returns and variances and covariances, again, you have that measurement problem, the fact that these things can't be observed in real time. So I'm very skeptical of that claim as well.
Larry, let's turn to incentives now. As you've said, private equity funds command high fees, and it's therefore in the interests of PE managers to gather assets. You've also explained how illiquidity makes it hard to value private assets. What evidence is there that funds exploit this lack of transparency to their advantage?
So, the main measure of return before final liquidation is something called, internal rate of return. There's an Excel function for that, for example, right? Just a series of cash flows. What's the internal rate of return? That's a primary metric that's used before fund liquidates. There was a 2022 paper that's cited in mine. There were some University of Florida researchers. They documented a quantitative analysis that they did that provides evidence that private equity limited partners, the investors seek general partners that inflate interim returns. And the investors, the point being that the investors actually like these inflated returns and they like the apparent lower volatility. These researchers coined the term catering. So they said that the general partners are catering to the limited partners in this respect. They did some quantitative analyses that provide some evidence that there's some manipulation. Like they looked at different circumstances, if another fund was being raised by the same company, things like that. And they found some, what looks like fairly compelling evidence that there is some manipulation of these returns. The paper also explains how the manipulation can be accomplished. They also cite some other papers. So, anyone who's interested in this topic, I would probably recommend that paper as a good place to start. But there is evidence. These researchers and others have identified some.
What about investment consultants? Why do so many consultants recommend private equity exposure, do you think? And why do so many trustees follow their advice?
I cite a 2016 annual meeting of Berkshire Hathaway shareholders, and Warren Buffett kind of went on a bit of a tirade about consultants. And the article was called his epic rant against Wall Street. So anyone who wants to Google that can look up the Wall Street Journal account, which is a pretty good account. Fairly, I found it amusing anyway. As he put it, you don't get to be a consultant and collect large annual fees by telling your clients just to sit in an S&P 500 fund forever. Even though that may be the best thing to do. Consultants have to bring ideas. They have to suggest annual tweaks. And one of the things they can suggest to make them sound sophisticated is to invest in private equity. Private equity has, kind of certain sexiness, if you will, to it. One of the other things that consultants do to supposedly demonstrate added value is to evaluate fund managers, including private equity fund managers. So, and other active managers. So, their whole, part of their whole shtick is to, is to do something. Don't just stand there, do something, and to help us do something that looks kind of cool. Now, in terms of why trustees follow their advice, one kind of apparent reason on the surface is that a lot of these trustees may not have sufficient expertise to question the advice or, to critically question it. So a lot of the trustees probably buy into the claims of superior returns. But there is, there is one, I think, underappreciated incentive that is kind of close to my heart, that arises from the way that actuaries calculate liabilities. I'm not going to get too technical, but actuaries discount liabilities using a discount rate that's based on the expected return of the portfolio. Now, this violates basic finance principles, but what it means is that if you invest in private equity and the private equity is thought to have, a 2 percentage point higher return, not only are you saying that you expect to get the higher return, but it also lowers the measured liabilities. And that means that also will lower required contributions. So it kind of allowed, by having private equity in the portfolio, it allows kind of this gaming of the liability, if you will. This University of Florida paper, there was what I thought was, they cited what I thought was a pretty astonishing admission by the CIO of the Idaho Public Employee Retirement System. He said, and there's actually a video out there that you can watch on this. And he said that he was skeptical of the claims for private equity superior returns, but as long as actuaries and accountants believed them, they would invest in private equity anyway, because doing so results in lower near-term contribution requirements, and he actually he called this phony happiness. It's considered illusory. He says the expected returns aren't real, but the reduced contributions that result from the actuaries using them, are real. And that's a big incentive to believe them, even if you don't really believe them.
Of course, a consultant can add value by recommending a private equity fund that goes on to outperform. But of course, identifying a future outperformer in advance isn't easy, is it?
No, not at all. David Swenson was probably who was the chief investment officer of the Yale Endowment starting in the mid 80s. He came up with this model of investing in private equity that a lot of these pension plans have copied, a lot of other college endowments have copied. It's referred to as the endowment model, or sometimes even the Yale model. When he started investing in private equity, in the late 80s and outperforming, kind of a conventional wisdom grew that one. And, he would say this: you need to make sure that you're picking the top performing managers, and, the top quartile performing managers is kind of how it's been translated. As I was saying, the difference between the top and the bottom is huge. But it's virtually impossible to know in advance who's going to be or what fund is going to be a top quartile performer. There was a pitch book study that found very little persistence among private equity companies. So even if you have a top performing fund, from several years ago, that doesn't mean that the new fund that you're raising money for is necessarily going to be a top performer. There was an article accompanying this study where one of the people who did the study joked that, or he noted a joke within the industry that you never met a manager that was not top quartile. And there have been other academic studies as well that show that a lot more funds are claiming to be top quartile than is possible, a lot more than 25% of them. And then another study found that during a fund's life, 80 to 90% of them will hit at least 3 quartiles in terms of return to that point relative to other funds of similar vintage. So, it's very hard to find, to know in advance.
In the conclusion to your paper, Larry, you say this: there is good reason to expect private equity to disappoint going forward. The full extent of this disappointment, however, may not be apparent for many years, long after those deciding to invest are gone. What exactly do you mean by that?
It refers to the fact that the ultimate success of a fund typically isn't known, for 10 or more years after the initial investment, and that 10 years is often longer than the future tenure of the people who make the decision to invest in a particular fund. So it's hard to hold people accountable for an investment that turns out badly. So they can make all kinds of claims when they make the investment, but the way it ultimately turns out, they may be on to something new, or maybe they've retired or whatever.
Finally, Larry, you're not an investment advisor yourself, but having researched this sector in some detail, what sorts of questions, briefly, do trustees need to be asking before investing in private equity or increasing their exposure?
Yeah, I think the main one is whether to invest at all, and if so, why? Do you believe the claims of higher returns, lower volatility, and diversification, despite all reasons for skepticism? Are you certain that whatever exposures you're seeking can't be realized with publicly traded investments at much lower expense and higher transparency and more liquidity? Are you certain you could outperform, if you're a public pension fund, you sure you're going to outperform Nevada, which has like a 3-person investment staff and invests, almost exclusively in index funds, and has outperformed almost every other public pension plan in the country? Given the difference between top and bottom quartile performers, why do you think you can identify the top quartile future performers instead of the bottom quartile performers? And then if you even, despite all this, you decide to make the leap, one question is, why do you think you have a top performer? Have you negotiated the most advantageous side letter possible? Have you gotten the most advantageous the most advantageous terms from the general partner that you can in terms of enhanced reporting, enhanced liquidity, ability to co-invest, things like that. Another question I would say is, how much is the general partner investing of its own money alongside you, so that the general partner has some skin in the game? Typically, it's not that much. I think 5 to 10% of the fund, maybe. But, mostly it's other people's money they're investing. But, it would certainly be a good sign if they were investing some of their own money. Also just a general understanding of what fees are passed through to limited partners as opposed to being covered by the general partner as a cost of doing business. A lot of fees that are incurred are, in fact, passed on to limited partners, which lowers their return. Do they understand, or are they okay with, some terms that allow the general partner to extend the fund term beyond the target date? You probably want to take a close look at that, because you want to make sure you'll be out when you need to be.
You've been watching an interview with Larry Pollack, author of Is Private Equity a public financial hazard, a research brief for the Reason Foundation. You can download the report via the Reason Foundation website. Just go to reason.org and type private equity in the search box. And if you're an institutional investor and have further questions on this subject, why not get in touch with my colleagues at IFA Institutional? You'll find them at ifainstitutional.com. That's ifainstitutional.com. Thank you to Larry Pollack and the Reason Foundation, and to you for watching.